All right, so this is going to be the midterm review. And somebody asked one time, they go, wow, the slides didn't move. They didn't change. Yeah, no, it's going to be this same slide for whatever the 20 minutes, 25 minutes, whatever it takes to get through this for the review. Those are the outlines of it. You know, Blackboard, 40 questions, multiple choice, 60 minutes. So this was the same slide that was on the end of the lecture I just did a while ago. So the way it's going to work, it's on Blackboard, so you open it up at your own, choosing. Once you do, though, you get 60 minutes to finish it. If there's a major issue, whatever, you can, maybe get the thing reset. Depends on the situation. But I know sometimes there's glitches that happen, so make sure you've got a charged up battery and all that stuff, because the system's pretty unforgiving. When it shuts down, it shuts down, and it just submits your score. And if you've got 5 questions done, not a good situation. So anyway, I'm not necessarily teaching the test directly. We're just going to do a pretty good review, because we want to hit the important areas to make sure that we have a kind of a common understanding. So one other thing too, some of these questions are going to be a bit redundant, meaning that the same question will hit kind of the same topic maybe a couple times, which is good. If you know the material, it's one question, 3 sometimes. But if you don't know that particular concept, it's going to be kind of painful. So one big thing is opportunity cost, and I think I've hit on this a bit. Opportunity cost is huge. You can only kind of be doing one thing at a time. If you've got $10, $1 million, $1 billion, once you spend that money on one particular thing, you typically can't be doing something else with it at the same time. So if you're up to your eyes in debt from credit cards and stuff, well, that's money that you're not investing, because that money's taken someplace else. And everything in finance is has to do with opportunity cost. So just a brief definition of that is, it's what you give up as a result of making a decision. So if you make a decision, there's obviously going to be an equal and opposite decision on the other side. And to make no decision, is a decision in itself. If you decide not to invest your money, well, just because you didn't take any action doesn't mean that you haven't made a decision, and you're going to have some consequences from that, good or bad. So another question here on opportunity costs, and this specifically, talks about somebody perhaps buying a car rather than paying off their student loans. The problem with young folks is and again, I sound like a boomer here, but if you get up to your eyes in debt, whether it be from student loans or car loans or whatever, that whole process, that whole time value of money, compound interest, if you delay, I'll save when I'm older, I'll worry about that stuff when I'm older, that money that could have been invested accruing interest for many, many years, you're going to have to put so much more money. You really are going to have to save a lot later in life to try and catch up for what could have been hopefully a fairly balanced life by just designating a reasonable percentage of your income from the start at an early age. Which kind of leads us to the next question, has to do when retirement planning should commence. When should you start thinking about retirement planning, particularly from a financial state? Pretty much as soon as you start working. I mean, you should always be thinking ahead about what's going to happen. And I've already mentioned to you that, you can use your retirement accounts to buy other things if it's done correctly. I mean, there's, maybe we'll talk about it at some point, but there's a very unfrequently used rule that the IRS has that's out there. And to my knowledge, I'm the only one, at least in Alaska, who's ever taken advantage, and I've done it a couple times. I bought big chunks of property with my 401k IRA. It's kind of involved, and you got to deal with some companies that not all of them have the best reputations. I did find a good one, but I had to do a lot of research. But I was able to, when I didn't have, basically cash available and didn't want to take a screaming loan, because a lot of times for raw land, banks have no interest in loaning money on raw land. They like to loan on houses with mortgages and stuff like that. Anyway, I'm saying you're able to draw against that. So not trying to turn this into a lecture, but the correct answer in terms of retirement planning is the answer that starts with now, basically, as soon as possible type thing. If you've got a situation where your spending exceeds your income, you need to get that under control. You can't, trying to make more money, trying to sell assets, trying to borrow money, getting another job. It's just not, going to be a sustainable thing. You need to live within your means, whatever those means are. So, it's not bad to perhaps get a second job, but if you're having to do that just for survival, then you are in survival mode. And what we're talking about here is financial planning, where you're trying to come up with a plan to keep you out of survival mode. So anyway, if you have a normal situation in life, meaning no dire medical needs, not everything happening at once, and you're still not able to cover your bills, you got to get that sorted out. It's obviously quite common to have financial situations develop, but that should be the exception and not the normal day-to-day existence that you're going through. All right. Liquid assets. So what do we mean by liquid assets? Liquidity has to do with the ability to turn an asset into cash, right? So is cash liquid? By definition, it is. Are stocks liquid? Pretty much. You can get that money settled out there in 3 days. Now, you can see that liquidity has nothing to do with any sort of wisdom. I mean, just because I could sell a stock in 3 days doesn't mean I want to. If the price is down and it's something volatile, I don't. If I expect it to go up or I expect it to change, but that's not addressed under liquidity. Liquidity is simple. Liquidity just means how fast something can be changed into cash. By definition, the opposite of liquid would be real estate. Really, it's tough. Real estate transactions are complex. They can go quick, but they can also. A conventional real estate transaction between you and the buyer and the seller and the listing and inspections and getting loans lined up and the acknowledged, understanding on everybody's side that although you can't back out, this is absolutely, you signed your name. Guess what? People back out of those things all the time with very little repercussions. So you definitely don't want to count your money until a real estate transaction is settled. So on the one hand, the ultimate liquid asset is the definition of liquid cash. On the other end, real estate. When we're talking about student loans, car loans, all those other things, what are they? So your questions or your answers here, you look at the answers and you see some things. You have assets and liabilities. Well, these are things that you owe. So obviously they're a liability, right? And car loans, student loans, housing loans, are those less than a year? Never really. The terms on those are always a matter of years. So what's the definition of long versus short term in personal finance? IRS, everybody in financial world. If it's greater than a year, it's long term. If it's less than a year, it's short term. So, okay, you have all these loans. So they're all liabilities and they're all in the long term. So there you go. How do you measure somebody's wealth? Do you go, oh, wow, they've got a huge house. They're incredibly wealthy. Not if they've got a huge mortgage on it. It's really hard to, decipher at the surface. What you need to look is you need to calculate net worth. Net worth is assets minus liabilities. So don't, I actually had a job before I came here to Alaska. I was offered well in excess of $300,000. In fact, I could have done something. I was, down in the Middle East in Pakistan. I was going to be making $350,000 a year with virtually no expenses. I mean, it would have been, and most of it would have been tax-free. The propensity to get shot was quite high. I mean, I'm worth whatever, 150 maybe on a good day. What they talk about in the military situation, they talk about hostile fire pay. And so if they're paying me an extra $200,000, that's a lot of hostility. I would have, the odds of seeing my family again probably pretty small. And oh, by the way, I would actually be in the military. I'd be a contractor, and those people die all the time, and it doesn't make the papers. So anyway, so was I considered a rich person? I never got that money. And other things, I've had jobs like that where I've made a tremendous amount of money, but I had tons of expenses, living overseas, having to pay rent. So you can't really measure somebody's net worth or financial wealth based upon their salary. Tax dollar of value, investment asset. Now, you really need to look at assets minus liabilities, net worth. Okay. Why do you want to monitor your debt level? Well, it gets back to one of those previous questions about if it's, unsustainable. If you can't square the corner at the end of the month. And lenders, especially in auto lending, man, they will let you get in deep. Home lending, people are a little more cautious. But just the same, you can get yourself in trouble. It's improved since 2007, 2008, but they had, watch the movie The Big Short. There's a concept of ninjas that do exist. People were getting loans for 4 or 5 houses, and there were ninjas. No income, no job, no assets. And yet they're credit worthy? It didn't make sense. But back then, and we're only talking 10 years ago, is that more than that? Shit, 20 years ago, where, people thought real estate can only go one way. Oh no, it can, but again, different markets. Real estate up here in Alaska, it's probably not going to be that volatile. The real estate there we're talking about, a lot of it was in Florida and places that are known for being explosive. So, anyway, we talked about debt level. We talked about concept of compound interest, basically, that if you're giving something today, if somebody says, I will give you $1 million today or $1 million 1 year from now, what do you want to do? If you've got any wisdom, financial smarts, whatever, you want the money now because you will invest that money. Now, in human nature, what happens with lottery winners? Yeah. But by definition, somebody who's buying lottery tickets is not good at math. It is a tax on people who can't do math. It's whatever. It's probably not something the government should be involved in, but here we are. But anyway, if you're properly disciplined, money received today is worth a lot more than the same amount in the future, because you can get that money today, invest it with compound interest meaning interest earned on interest, and you can turn that into a larger sum. All right. Plus, that money they give you, if they're going to give you $1 million a year, you're going to have another year's inflation working upon that $1 million, which means, yeah, they give you $1 million, but you can only buy, 990,000 worth of it, or whatever the inflation rate minus. So, okay. Another time value of money. Yep. So exactly, pretty much the definitions we're talking here. So that's kind of a twofer. If you know that, if you know opportunity cost, you're going to be doing well. And the next one's not much different. Earning interest on interest. Yeah, we've talked about this before. It's, whatever. You can look up the quotes. They're often attributed to the wrong people, but supposedly Einstein said that, this was a wonder of the world, compound interest. Because truly it is. Maybe it's a bad subject. I guess there was just anyway, don't want to talk about nuclear stuff tonight. But anyway, earning interest on interest. Qualify for head of household. When we're doing taxes, remember how we have different categories on taxes? We have, the single category, which is going to be the highest amount of tax paid because, you're young. You don't have any, not always young, but you don't have any dependents by definition. You're filing single. What you would want to do is filing joint, because that has a lower threshold, and you could be the different categories out there. Or there's this other category that people are called head of household who have dependents, yet aren't married. Now, if say you just got a divorce and you had, one child, that head of household characterization, even though you're paying child support or whatever, no, only one person gets to claim that. The dependent can only be claimed by one parent. Here's a simple math problem about some stock. Somebody purchases some stock. So essentially what they're trying to figure out is how much capital gains is paid. And hopefully it's a gain. You can't obviously lose money in stocks. But anyway, so you sell it for one price. You bought it for one price, you sell it for the other. So hopefully you sold it for a profit. And how much profit? It's a little word problem. So you just do quick, big, round numbers. Not a calculator required here. And then you come up with this profit, and then you say, okay, but all my answers say short or long term. Well, how long did I hold that stock for? And if you held it more than a year, it's a long-term gain. So, a lot of times there's purchases, and this gets kind of dicey, especially if you're dealing in, a lot of times I've got volatile stocks where they get to a certain price, and you're like, wow, I'm just not comfortable it's going to stay there. Well, you got to make a decision, because if you sell it and it's within a year, you're probably going to pay, you're going to pay the same tax rate you pay on your normal income. So let's say, 25, 30%, versus if you keep it for a year, currently that rate would only be 15%, so roughly half. So it makes a difference. So here they're saying purchasing some item on credit. Then they've got a list of things you can purchase. And the only, so it says which one of these will help your tax bill. Well, the only type of debt where you can write off the interest is mortgage interest, right? Something you're paying on a home. So if you have things in there like cars and boats and all sorts of consumer stuff, yeah, that went away a long time ago. Used to be able to write that off, but whatever, that lobby didn't pony up enough money, and that got written out of the bills. The mortgage people, the real estate people, they're pretty squared away. They have made sure that it's financially advantageous to own a home. So you got to kind of play the game you're given. That's why real estate is a taxed favored investment over a lot of things. There's also something that doesn't come up here, but how I'm talking about getting hit on capital gains. Let's say you buy a house for $200,000 and you sell it for $500,000. This is probably one of the best sales you're ever going to have. So that's probably the largest capital gain. So this interest rate makes not interest rate, but this tax rate makes a huge difference on you. Well, guess what? If it's real estate, you've lived in the house for 3 out of the past 5 years, and there's some other considerations. You have to look at the IRS rule on this, but it's tax-free. I mean, that is major. I had a friend, he was in Spain with me, and he invested in a bunch of real estate, and he stayed in and got clobbered. He got out the year after I did, and the market just dropped. So he had a house, and he was in the U.S. Air Force, but he was anyway, he spoke fluent Spanish and stuff, and he grew up like in East L.A. or something. Bad neighborhood. Because of his situation, he had to move from Spain back into East L.A. for his retirement years, and him and his wife were going to have to live in this house for 3 years because they needed the more favorable tax treatment by being, in the house 3 out of the past 5 years before they sold it. So they can get crazy, but we're all kind of rats trying to get the free government cheese, and the maze within the IRS is set up to encourage behavior, and people will sometimes have to do some pretty convoluted things to get it. Anyway, I'm getting off track once again. Financial institutions. So, how do banks and all these other people make money? What's their basic business strategy? They loan money to you at a higher rate than they pay their investors, the people who save with them. So why are bank rates, as low as they are? Because, the banks, they're making a profit. There's that spread. When they're paying you, maybe 1% or 2%, and they're loaning it out and charging, say 8% on a car loan to somebody, that's where they make their money. But, personally, whatever they do, it does not matter to me. I don't keep cash in banks other than for transactions. I try to keep 100% invested. The stock market, it has its ups and its downs, but over the long term, as long as you don't do any panic selling, 10%, it's been doing that for over 100 years, 10% a year. And it's not every year. Some years are low, some years are high. But when it averages out to 10%, until that changes, that's where I'm at, other than crypto, obviously. Here's another one about quick access to funds. So that sounds a lot like funds, as in cash, quick access, as in liquidity. So it's, there is some repetition in here. Some people use credit as a source of liquidity. What would a disadvantage of that be? Well, the only disadvantage is finance charges if you don't pay your bill. If you, get your bill paid within that credit cycle, if you have your emergency fund off someplace else or maybe in some sort of fairly stable investment and you can get the money out of there, you have a less liquid account, but you can get it liquid within 30 days, you can get access to cash, then you can pay off that bill, and it's, as far as you're concerned, it's a victimless crime. You don't pay any finance charges if you met the constraints imposed by the credit card, so you got free use of their money, which is nice. We talked a little about stopping a payment on a check. Not often used. What happens here is, somehow a check's gone missing, or you wrote a check and it hasn't cleared yet, and you want the bank not to honor it when it's presented. You can get a stop payment. But when does that work? Only if it hasn't cleared. Which, when you're using electronic clearing, means that you're dependent upon the speed of the technology. If it's someplace with modern technology, it's probably cleared quite quickly, like a debit card where it's done electronically. When you have a checking account and you want some sort of protection against it for, extra bills and all the rest of that, there's no way to really talk around this. Overdraft protection is something that you pretty much need, especially in a world with, debits coming out of your checking account. It's bad enough when you just have to keep track of checks, even though most of us don't write very many checks. But when you have electronic means like debit cards and ACH debits and other things coming out, it's not unusual for a slight mistake to happen and you to overdraft your account. If you have proper protection, it'll just roll onto a credit card. Worse than having an occasional overdraft that's covered is never having an overdraft, because you're keeping, 10, 20 grand in your checking account that's sitting there idle. They're not giving you any money for that, or not anything that's keeping up with inflation. So it's much wiser in my mind to, accept that you're going to kind of keep a minimum balance in that checking account. Not minimum, you don't have to stress about it, but you certainly don't want idle thousands in there for identity thieves to, potentially grab, or you just, waste your time. Idle cash is not doing you any good. Okay. Golly, I've gone long already. I'm trying to push this up. We're on number 20. Valid reasons to borrow funds. So, yeah, there's all sorts of different reasons. Not trying to get in your personal lives, but if you're doing it for day-to-day stuff, yeah, you might have a problem. So, you again, living within your means. We talked about credit cards. I think I beat that to death on more than one occasion about being a convenience user. And that means not carrying a balance. You got to get it down to zero. So now again, there may be charges that you just charged yesterday and the credit card statement closed out a week ago. You just need to keep it current within the month. Anything that goes over 30 days, typically you're going to get dinged on, and you're going to get interest charged. And their interest rates are exorbitant. Credit card cash advances, yeah, not a good situation. Don't do that. Don't, debit cards or whatever, ATM card, whatever you have, it's not the same as using a credit card. If you actually take a cash advance on your credit card, that's pretty painful. There's going to be a convenience charge typically, and then the interest, there is no grace period. They start charging you interest. You can't pay off your bill at the end of the month. And no, the interest started being charged the minute you took that money out. Zero grace period. But again, I've ragged on the credit cards so far, but they can be, a great source of emergency funds. But again, this comes back to having it paid off. If you've got a credit card with a $20,000 or $30,000 limit, and you've got it down to zero, you can sort some things out before you get in dire straits, because you've got that available credit on your credit card, and you've got, like I say, typically a month to get that money back in the account before you even charge any interest for it. All right. We've hit on finance charges, what they're due. APR. Those are the key words, right? Those are the legal words. Annual percentage rate. So that's what you're looking for. If you see an interest rate on anything that's quoted, it's meaningless unless you see the little APR next to it. Because there's different ways to calculate interest. And the only one that's valid for comparisons is the annual percentage rate. That has a distinct legal definition. Credit card statements, how often should you review them? All the time. And you're looking for fraud, you're looking for bogus charges, and you're also doing some sort of backwards budgeting. You can see where all your money went. That's why I'm kind of a big proponent. I try to spend a lot on that, just because now it's so much easier with tapping and everything else. You used to be that annoying person in line because it took longer. Now the annoying person is one with cash. So anyway, collateral. What is collateral? Collateral is what you want. It's a good thing for you. Collateral means that the bank has the opportunity to repossess your car, or your bank, or your boat, your house, your whatever. But it also keeps the lender in a comfortable, secure position, which means that they're going to give you a lower interest rate. If you have a loan that's just a signature loan, an unsecured loan, whatever, that has nothing obligated against it in case you default, it's going to be an expensive loan. You don't, whatever. You would much prefer to have a loan that's tied to a specific asset, and that way they give you a good interest rate and you get it done. So collateral is that item, that house, their car, their whatever that they're going to repo from you. And the next question's right in line that. Which type of loan has the lowest interest rate? Obviously, it's going to be that secured one. We talked about cosigners. Don't do it. The question on here has to do with, oh, I only co-signed the loan. They can't seize my assets. Oh, yeah, they will. They can. They prefer to seize your assets. They're probably not even going to look at the original loan originator. They're going to go straight to you because you have better stuff. you've got more assets. You were able to co-sign the loan. That other person was not. So, yeah, they're pretty merciless. So you're purchasing a home. Who pays the commission? The big expense, generally 6% of the purchase price. That's paid by the seller. So, make your own decision when you're selling your home. I still think you're all right, or smart thing to do is to have an agent list your home. But anyway, if you choose not to go there, it's understandable because, you will have to pay that agent the commission. So you sell a $600,000 home. I mean, that's $36,000 gone. Now, if this agent's going to market the home and get me that, price I want and everything else. Besides, if I'm buying a house from a for sale by owner, I know that this person's not having to pay that commission. So if the market for that house is, $636,000, well, I feel like I ought to split the difference with him. I mean, I'm not going to give him a full price offer when he's not even have to pay real estate. So I'm not sure whatever. A lot of psychology in that, but you make your own decision on that. But if you're buying a home, kind of a no-brainer since you're not the one paying for the agent. And you're not obligated to buy from them. If you find another home that's for sale by owner, you could certainly do that. So we talked about the commissions, HOAs, homeowners associations. So, advantages and disadvantages. And there are some good things, but there are also, restrictions that you sign up for. Things that you may think are, within whatever. You want to put up some flags, or especially in this season, I'm sure there's some HOAs that prevent political flags. I don't know. It's just, I don't want to go there. I don't, I've got, anyway, but if you're somebody who can sacrifice being told what to do a little bit for, and are able to play nice with other people, then maybe it's for you. But anyway, fixed rate mortgage. What is true about that? That remains constant the entire length of the loan, right? It's a fixed rate mortgage. So not an APR, no adjustable, not APR. I've got the acronyms confused there, but the APR, I guess you could use that thing, but it's not an adjustable rate mortgage. It is a fixed rate mortgage. So let's say your mortgage payment is, $2,000 and you're like, golly, that's kind of high. 30 years from now, $2,000 will be nothing. When I was growing up, my parents had a mortgage, and I remember it was $133 a month. And that was pretty low back then, too. But it was just they'd had that mortgage a while, and, $133, well, hell, you used to be able to buy a house with it. So the term I was looking for that I screwed up there is actually embedded in the next question, an ARM, adjustable rate mortgage. And so we inadvertently just covered that one as well. So what's an ARM? Adjustable rate mortgage. It means a mortgage that typically, you wouldn't do it unless it had a lower introductory rate. But from then on, it becomes a floating rate that's tied to inflation. And if inflation goes up, it can go up. It can also go down theoretically. But if it does go up, it can only go up at a certain rate. It can't double overnight. But it can creep on up there, staying within the limits. And in time, it could double, but it would take a few years. Talking about insurance, kind of switching gears. Risk management strategies. Yeah, so you avoid risk. That's good. You can accept risk. Oh, okay, I can deal with this. You can insure against risk, but to ignore risk, no, that's not a good idea. Comprehensive coverage. So we know collision covers when you're at fault in an accident. We know liability covers for the other person. And we know comprehensive is just what it sounds like, where it covers all the other stuff. And a lot of times these aren't even driving type things. Windshields, wind, hail, stuff like that. We know what a deductible is. That means the amount of money you got to pay before they start paying. Or the amount of money that you'll, collision bill will be 10 grand and they write you a check for 9,800 or maybe 9 grand. Depends what your deductible is. That amount is going to be minus. What is not covered in standard homeowners policy? Floods. So floods, it just goes against the concept of insurance. Bad things can happen to a lot of people simultaneously. And if an insurance company was to write a policy for that, they would do so fraudulently because they would not have the resources to pay all those people at the same time. So they've tried before, and that's why the government just outlawed it. It's only a federal program. We talked about if you've got a homeowner's policy with some specific items, some nicer things, yeah, you need an extra policy onto that. So it can be called a floater, a rider, an addendum. So some sort of thing that's going to specify those items and acknowledge that they are indeed insured. What's a good way to reduce your homeowner's policy? Same way it is with auto insurance policy. If you can handle it, you can increase the deductibles. And then lastly, on health insurance, what's the good thing about health insurance? Or I don't know how they've got it read here, but keep in mind that the majority of people out there have some sort of insurance with their work. They get it through their employer to help subsidize the cost. So that is the most common way. All right, so took a little longer than I thought, but that'll be that. And good luck on the exam. Let me know. Obviously, it'll be posted next Saturday. It'll close out at midnight on the 19th, which is the following Saturday.